So if you're studying finance right now, or honestly, even if you've just picked up a couple of personal finance books over the years, you've almost certainly been handed what feels like the ultimate financial life hack, the undisputed textbook safety of passive investing. Right? We're all taught the golden rules of modern portfolio theory. Diversify, keep your fees as low as humanly possible, don't even try to beat the market, and just let the index do the heavy lifting for you. But what happens when the exact strategy that built millions of portfolios starts to fundamentally rewire the market itself? Well, welcome to this explainer, where we're going to take a really hard look at the source data to see if the undisputed champion of wealth building is maybe starting to show some hidden cracks. Here's our roadmap for the breakdown today. We'll start with the passive investing revolution, move into the hidden concentration risk, check out the AI feedback loop, dive into the passive bubble debate, and finally, look at the future of investing.
All right, part one, the passive investing revolution.
Okay, let's actually rewind for a second, because we need to understand the massive paradigm shift from the grueling era of active management to the practically effortless victory of passive indexing. For most of history, investing was just a grind. Active investing meant putting in brutal hours, digging through massive 10K earnings reports, modeling out cash flows, and basically trying to predict the future. And the harsh reality for all that sweat equity, it came with exorbitant management fees, a brutal tax drag from all that portfolio turnover, and the sobering statistical fact that over a 10-year period, the vast majority of highly paid active managers completely failed to beat their benchmark. And then, the passive revolution hit. The idea spread like wildfire because it was just so simple. Why try to pick the needles out of the haystack and pay all those fees when you can just buy the entire haystack? One simple investment giving you exposure to hundreds of companies with literally almost zero effort. Which brings us to the core concept here. Index investing is exactly that strategy, where an investor buys a broad market index to get exposure to hundreds of businesses simultaneously. For the finance students listening, this is the textbook ideal of diversification. Let's take a real-world proxy, like the S&P 500. When you buy a single share of an S&P 500 index fund, you are instantly fractionalizing your dollar across 500 of America's largest businesses. And because the fund is just mechanically tracking a list, those management costs drop to basically nothing. Plus, unsystematic risk, the risk of one specific company going under and dragging your whole portfolio down with it, is practically eliminated. If one company stumbles, another one succeeds. Returns improved and trillions upon trillions of dollars just flooded into this strategy. It works so flawlessly that, honestly, people just stopped questioning it. Which leads us to part two, the hidden concentration risk. So what exactly happens when a strategy becomes so successful and so universally accepted that investors totally stop looking under the hood? Well, we start running into a hidden risk. And the flaw in the formula comes down to something called market cap weighting. This is an index structure where the larger a company becomes, the larger its influence and space inside the index. Imagine an index is a 500-person choir. You'd logically assume everyone's voice blends together equally, right? But because it's size-weighted, it's actually more like 10 people in the front row are holding giant megaphones, while the other 490 people are just kind of whispering in the background. Simply put, the bigger the company, the louder the megaphone. That choir analogy perfectly hits the nail on the head when we look at the reality of the market today. In a 500 stock index, you'd expect a beautifully, highly diversified mix, but instead, a massive chunk of the value is dominated by just the top technology giants, which leaves the remaining 490 companies fighting over the scraps. Let's ground this in reality for a second. In major indices today, mega corporations like Apple, Microsoft, and Nvidia command wildly disproportionate percentages of the entire index weight. This creates what we call pseudo-diversification. You've got millions of passive investors walking around thinking they are perfectly diversified broadly across the whole economy, but their fate is heavily, heavily tied to just a few mega corporations. The math here is stark. If just 3 or 4 of those top tech giants miss on earnings, or, say, face a massive regulatory crackdown, the diversification of the other 490 companies mathematically cannot cushion the blow. The entire index is going to feel that shockwave. So let's look at what's accelerating this. Part 3, the AI feedback loop. So what is actually driving this massive concentration at the top? There's a real-world catalyst pouring gasoline on this top-heavy phenomenon right now, and it's the massive economic shift brought on by artificial intelligence. Let's walk through the mechanical flow of capital that happens every single day. Just think about what happens on the 1st and 15th of every month. Millions of retail investors have their 401k accounts set to auto deposit, right? So that money enters the index funds. Because those funds are market cap weighted, they automatically buy the largest, top weighted stocks, many of which right now are the AI and tech giants. They buy completely blind. They do not care about price to earnings ratios, underlying valuations, or debt levels. It completely bypasses normal price discovery. All this automatic buying causes the stock prices of those specific giants to rise even higher. And guess what? Because their price went up, their index weight increases even further. The cycle just repeats. Blind passive money is continuously inflating the largest stocks in a relentless feedback loop. It's literally a machine that buys more of a company simply because it's already big. Now, we're getting to the controversial stuff. Part 4, the passive bubble debate. With all of this automatic money flowing straight to the top, it's naturally sparked a massive debate among financial analysts. And it brings us to a multi-trillion-dollar question. Could passive investing actually cause a bubble? Think about it. What happens when trillions of dollars buy automatically, completely ignoring a company's underlying valuation or broader macroeconomic conditions? Traditional investing is built on analyzing profits and debt, but passive investing, it just unconditionally buys whatever is put in front of it.
It is absolutely crucial to understand both sides of this argument. On one side, we have the critics. They argue that because automatic buying completely ignores valuation, the stock prices of these mega-cap companies become totally disconnected from actual business fundamentals. They're saying it distorts the whole market and inflates valuations to totally unsustainable heights. But on the flip side, supporters have a really compelling counter-argument about market mechanics. They point out that even if you consider passive capital to be dumb money that buys blindly, it only takes a small percentage of active, fundamental traders at the margin to establish the correct market clearing price for a stock. Active investors, the folks actually reading the earnings reports and hunting for arbitrage, they are still out there trading at the margins, setting efficient prices and keeping the market functioning normally. Honestly, we are impartially watching an unprecedented real-time market experiment play out. Nobody knows exactly how it ends simply because passive investing has never, ever been this dominant before.
So what does this mean for us? Part 5, the future of investing. Bringing this all together, what does this actually mean for your portfolio? Well, before we sound the alarm and throw out the textbook, we have to remember why passive investing's core strength is still incredibly vital. It protects us from our own worst enemy, us, human emotion. The average investor routinely underperforms because of fear, greed, panic selling, and overconfidence. Passive investing protects people from those deep, psychological, and highly costly errors. Even if the market is top-heavy and concentrated, buying a broad index and just holding it patiently still prevents you from panic selling at the absolute bottom or aggressively chasing some meme stock fad at the absolute top. However, the ultimate takeaway from the sources today is that we might be witnessing the end of blind passive investing. Look, passive investing isn't dead. Far from it. But the era of just blindly assuming your index fund is this perfectly balanced, equal representation of the whole economy, yeah, that's over. The future belongs to investors who can combine the mechanical simplicity of the index with a critical awareness of what they actually own. If you're a student going into wealth management right now, you can no longer simply set it and forget it for your clients without understanding exactly which megacaps are dominating their underlying holdings.
I want to leave you with a really powerful thought directly from our source material. The market rewards patience, but it punishes complacency. It perfectly summarizes the crossroads we are at right now. Be patient with your investments, for sure, but do not be complacent about understanding where your money actually lives. Challenge those textbook assumptions, stay vigilant, and seriously ask yourself, do you know what's really inside your index fund today? Thanks for joining me for this explainer, and keep questioning the consensus.